The following podcast was recorded on Thursday, April 21st, 2022, featuring Sam Rines of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Sam Rines of Arbor Data Science. Welcome, Sam.
Hey, good to be here.
Today, Sam is going to explain why it might be worth watching Sotheby's gavel. If we look back at 2014, following the flooding of crude from the OPEC cartel, the market asked how long low prices would last. The consensus was lower for longer. Let's fast forward to 2022. Oil is back to over $100 a barrel. Is the narrative now higher for longer?
Yeah, the narrative completely changed, and to the point of, we were saying, every time oil prices go up, we're going to get more fracking. We have West Texas. We figured out how to get all the oil we'll ever need out of there, and to a certain degree, that's right. We do have a lot of oil reserves in West Texas. Dakota, the U.S. is energy independent in a lot of ways. We're actually an exporter of LNG in a pretty significant way, and it's a pretty stunning thing. The issue now is that you just don't have the labor to get the oil out of the ground. You don't have the permitting. There's a significant amount of regulations around it, and that's creating, not to mention you can't find pipe or concrete. Or really fracking crews, again, a labor issue. So what we ran into here was a situation where oil prices are elevated. We should have had a much larger reaction out of West Texas and U.S. oil producers, and we simply haven't seen it. And it's unlikely that we're going to see it in a way that we would have seen it in 2013, 2014 with oil prices north of 100. It's worth remembering that for the better part of 2011 to 2014, we were well over $100 a barrel for crude. And the oil volatility is probably here to stay. Not only do we have uncertainty about supplies, we also have uncertainty about demand. So it's been a pretty interesting week when we think about earnings. Everyone wants to talk about Netflix and how dismal their earnings were, losing subscribers, all that stuff. Maybe people are cutting the quote unquote subscription cord and moving on to stuff that's more out of the house, getting back out, less COVID restrictions, no masking, and you've begun to see some pretty stunning earnings out of airlines, and airlines use a lot of fuel. That's an increase in demand for, guess what, oil. So that's probably going to add a little bit of a demand side volatility on top of a supply side volatility. So the volatility in oil appears here to stay, kind of regardless of what happens on the supply side.
What else is there in the oil trade? Do other markets tend to follow oil prices tightly?
Yeah, so there's a chart that I like to point out that is the art market and oil prices. And if you go to the old masters chart number 2, there's this really interesting correlation between oil price spikes and art price spikes and the art market. One of the reasons that I think is pretty interesting behind this, and everybody knows it, is that when the economy is good, oil prices tend to rise. I mean, that's one thing. But there's also the side that when oil prices are higher, you tend to have windfall profits, very similar to almost a tech buyout type deal. When you have a significant amount of buyouts in the technology industry and everybody is getting big paychecks, there tends to be more Teslas bought or more Lamborghinis, Ferraris, big homes, whatever. When it comes to big windfall profits in oil, they tend to be very large and they don't tend to last very long. So you tend to pay them out very, very quickly. And guess what? You don't tend to reinvest those profits back into oil. You tend to put them somewhere else, and one of those places is oil. It's worth remembering that the Da Vinci, whether or not it's a Da Vinci, it's a great documentary, was bought by MBS, the head of the Saudi family, in 2017, right? Again, windfall profits from earlier in the decade put into art. So I think it's a pretty interesting story of when the economy's good, oil's good. When oil is good, so is the art market, and it just tends to be that way. And it's one of the more stunning things out there.
And art's being a very intriguing asset class when you think about what you can do with it, meaning, and I'd like you to talk about how it's different than where it was a decade ago, but thinking about borrowing against art, buying fractional pieces, buying loans backed by art.
Oh yeah, so it's interesting, and this is the big caveat. And if you pull up chart number 3, I think you can kind of get a feel for it. There's a big caveat when it comes to oil being somewhat correlated or highly correlated with the art market. The big kind of at the moment is it's changed a lot. The art market has over the past decade. It has changed radically. You can now buy a fractional share of a portfolio of art, whether it's post-war, whether it's modern, whether it's postmodern, whether it's whatever it might be. You can buy a fractional share of it on your smartphone. You could not do that in 2010. That's a complete sea change in terms of call it the liquidity of the art market. Right? You've created much more of a, call it a pseudo demand for an alternative asset class in art. That's a differential marker, right? There's a little bit of a call it more clarity in terms of pricing, simply because you're having much more turnover, at least in portions of the art market. So you get a little bit better of a feel, instead of this piece of art might be worth 10 to 15 million, right? When you get a catalog from Sotheby's, you tend to have very wide, call it bid-ask spreads on these pieces of art and what they're expected to be worth. So that's changed. On the debt side, it's been an incredible, call it decade of change in the ability to borrow against art. So if you're a wealthy client of banks, you can typically go to your private wealth department and get a loan for up to 50% of the estimated value of your piece of art, which is can be quite a bit. And you can use that to either go buy another piece of art. You can use that to invest in the stock market, invest in your business. It's a pretty interesting world, and how it's changed over time. One of the intriguing points about that is this time might be different in terms of who's actually exposed to art relative to who was exposed to art over the past, call it century, right? It tended to be only the top 2 to 3% of earners and wealth that had significant investments in art, the 2 to 200 million type pieces of art. Now you have people with far lower resources investing in very small portions of very expensive pieces of art.
So speaking of top earners, we want to turn next to sentiment. Sam, we've had Fed tightening, soaring inflation, or we're about to have Fed tightening, soaring inflation, volatile asset classes. It's no surprise that sentiment is declining, and top earners are no exception. Can higher commodity prices offset these headwinds?
To the art market, it's kind of a give and take, right? Because you are going to have private oil companies and their owners making a significant amount of money, right? West Texas is going to do very well off this. Landowners, et cetera, they're going to do incredibly well. The problem is that the vast majority of Americans and top earners are not going to do extraordinarily well off of this, right? We're not, it's not the majority of individuals working in the oil patch or owning a ranch in South or West Texas. That's just not the case. But you do have, call it the Middle East is going to do pretty well. You're going to have a significant amount of, call it tailwinds to the higher price pieces of art, the more collectible pieces. The problem is that you're probably not going to have as robust a demand with these types of sentiment numbers from the vast majority of high earners. So you're going to have a bit of a give and take, but you're probably going to have more of a give on the art market side, just given that you're not going to have demand for, call it the $2,000 to $1 million pieces that you had previously. As you begin to really jack up interest rates, I mean, if you're taking out a loan on art, those are 1-year resets or 5-year resets typically at max, and those are going to reset at much higher rates. So it's going to be, do I borrow against this piece of art to go buy another piece of art? It's a different story at 5% than it is at 10 or 11% if we continue to have interest rates rise.
If investors are looking for signs of economic cracks, where should they look?
Look at Sotheby's gavel, and look at some of the art market auctions, and look at the demand and the pricing around those, call it $2,000 to $1 million pieces of art. It's a different market at the high end. That tends to be a little bit of a lagging indicator. It's one of the last ones to go, right? After oil prices crack, after the economy cracks, then you're going to begin to see it, but you'll begin to see signs at the lower end, quote unquote, of the art market much more quickly than you will at the high end.
Well, Sam, thank you for your thoughts today, and thank you everyone for joining us. As a reminder, we are client driven. If you have any questions or feedback on future topics, please let us know. For any questions on Arbor Research, Bianco Research, or Arbor Data Science, please contact Gus Handler at gus.handler@arborresearch.com. Have a great day.